All right, today we're jumping into a really critical investment strategy. We're going to look at a playbook designed for a pretty treacherous economic environment, and we're using the market of 1975 as our guide. This is all about how you can build a literal fortress for your portfolio. So let's dive right in.
So here's our game plan. First, we'll look at a warning from history. Then we'll actually unveil the Stagflation Fortress portfolio itself. After that, we'll break down the strategy behind it, lay out a really clear action plan for you, and finally, we'll talk about the signal, the one that tells you when it's time to go back on the attack. Okay, so let's set the stage a little. The whole strategy we're talking about today is built on one big idea, that we're about to see a repeat of the brutal market of 1975. You know, a time with crazy inflation and a really punishing bear market. And that environment created a very specific danger for mining stock investors, a scenario we're calling the miner's trap. And wow, this quote really frames the stakes perfectly, doesn't it? We're not just talking about a little dip in the market. We are talking about a potential death valley for anyone who isn't prepared. But, and this is the key, on the other side of that danger is an absolutely incredible opportunity. The whole game is just surviving long enough to seize it. So you've got to understand the enemy here. We're talking about a stagflationary correction, and it's just this brutal combination where inflation keeps driving up costs for miners. Think diesel, steel, labor, all of it. While at the same time, the price of the gold they're selling is actually falling. This dual pressure just completely annihilates their profit margins. Yeah, and this threat, it isn't simple. It actually attacks from three different angles. First, you've got the equity drag. That's where even the good mining companies get pulled down with the rest of the market. Second is that margin squeeze we just talked about, that silent killer of profits. And third, and this one is so important, is capital starvation. That's when investment money just dries up, which is absolutely lethal for smaller companies that need that cash just to keep the lights on. Okay, so that's the problem. It's serious, for sure. But the good news is there is a solution. So let's talk about the Stagflation Fortress, a portfolio specifically built to not just survive these pressures, but to put you in a position to thrive when it's all over. And here it is, the complete allocation model. But pay attention to the roles here. Physical gold and silver, that's your anchor. The royalty companies are your shield. Energy acts as the cost offset. Major miners are a strategic option, and that little slice of cash is your vulture fund for later. But look at the bottom. What's at 0%? Speculative miners. You have to see them for what they are in this environment. The trap. And this chart just makes it so clear. A whopping 40% is in physical assets. Then you add another 25% in royalties and 20% in an energy hedge. I mean, think about it. That's 85% of your entire portfolio sitting in defensive or offsetting positions. That is what a fortress looks like. So why does this specific setup work so well against a stagflationary correction? Let's peel back the layers and look at the three most important strategic pillars that make this fortress so incredibly effective. Now, this is where things get really clever. It's the pivot to royalty companies. See, a normal miner has to pay for every single rising cost, diesel, labor, you name it. But a royalty company? They have almost zero operating costs. They just take their 1 or 2% right off the top of the revenue, which makes them almost completely immune to that margin squeeze that just crushes the actual miners. They are, without a doubt, the ultimate shield. The next piece of genius here is the energy hedge. And no, this is not just a random bet on oil. It's way smarter than that. Since energy can be 20, even 30% of a miner's total costs, you're basically creating your own little internal hedge fund. If oil prices spike, yeah, your miners are going to suffer, but your energy stock is going to surge. The gain in one directly offsets the drag on the other. It's all about stabilizing your portfolio's total value. Okay, now for the emotionally difficult part, purging the speculative junior miners. Look, these companies don't make cash. They burn it to fund development. And in a long, drawn-out correction, they just run out of money. Then they're forced to issue tons of new shares at horrible prices just to survive, and that absolutely crushes existing shareholders. The plan isn't to hate them forever. It's to sell them now and buy them back later when they're truly desperate for cash. All right, let's switch gears from theory to practice. We've talked a lot about the why, so let's get into the how. This is your clear, step-by-step construction manual for rebalancing what you have now into the Stagflation Fortress.
The whole process is really just one big trade, and it happens in 3 phases. First, you have to sell or trim your most vulnerable assets, and you have to be aggressive about it. This raises cash and cuts your risk. Second, you immediately rotate that capital into the key defensive fortress positions we've been talking about. And third, you hold on to your core survivors, those big, stable companies that have the balance sheets to weather this kind of storm.
So, what exactly goes on the chopping block? Well, you're looking for companies that are really vulnerable to that margin squeeze, like miners with high production costs, and the ones at risk of capital starvation, like all those cash burning developers. Reducing your exposure here is what gives you the dry powder to build your fortress.
And where does that new capital go? Straight into the fortress walls. You build up your energy hedge with a major like Exxon, you create your royalty shield with industry leaders like Franco-Nevada or Wheaton, and you strengthen your anchor with physical trusts like PHYS or PSLV. It's a direct trade. You're swapping risk for resilience.
Now, this is so critical to remember. This is a temporary defensive position. A fortress is for survival, right? Not for conquest. So let's look to the future and talk about the specific triggers that will tell you the storm has passed and it's time to shift from defense back to offense. And this is probably the most important question of all, right? Because if you just sit in a defensive crouch forever, you're going to miss the next big move up. So how do you know? How do you know when it's time to unleash that vulture fund and go on the attack? Well, the strategy gives us 2 very clear, data-driven signals to watch for. The first is a capitulation signal from the market itself. This is when the junior mining index gets absolutely hammered, dropping another 40 or 50%. That's a sign of maximum fear. The second is a Fed pivot signal. That's when the Federal Reserve is forced to reverse course and start pumping money back into the system, either by restarting quantitative easing or QE or announcing yield curve control to force down interest rates. When you see one of those signals, the storm has likely passed, and the absolute best buying opportunity is right in front of you.
And this really gets to the heart of the entire strategy, doesn't it? This defensive fortress isn't about being timid. It's about preserving your capital. It's designed to be boring and defensive right now for one reason: to make sure you're one of the few investors left with dry powder, ready to deploy it when the real life-changing mania begins. It's about surviving the battle so you can win the war.